So the three classic original techniques of chart trading with the longest pedigrees are bar charting, candlesticks, and the third one is point and figure. I well remember working on the floors of the Chicago exchanges in the 80s and seeing traders packed into a small trading pit, each with a small trading card covered in a grid, and they would be doing, in the midst of the melee, they would be doing their point and figure charting, even as they were being jostled and thrown around. It's a fantastic technique for capturing breakouts and trends in the very short term. It works like this. Basically, whereas most bar charts and candlesticks are represented in a graph of price and time, the point and figure chart has no time scale. It's a powerful and interesting idea. Basically, starting from wherever you want to start, say the price is here, when you start charting it, if the price goes up by 15, 30, 45, each interval of say 15, blocks of 15, and it can be a block of anything, but one has to be consistent, goes up in blocks of 15, and before we represent a sideways move, we have to have a reversal of more than 3 times the unit that used to represent the initial change. So if it goes up in blocks of 15, it has to drop by 45, and that would be represented by that. It would come off 45 ticks from this high here. You'll readily grasp the point that, in fact, the movement along the y-axis is totally dependent upon a certain degree of fluctuation. If there is no fluctuation, there is no movement. If the market never retreats by more than 45, say it does a 45 retreat, we're represented by that, and then bounces back up, and then keeps going up. For a week it stops still, does nothing, and then the next week it keeps going up, and then it stops still, and then it drops by 15, no representation, drops by 30, no representation, because it has to drop by more than 3 times the interval used to represent going up, and then starts going bid again. This could go on, that could be a year's worth of price action, or it could be 10 minutes. The point of this system, and if you're interested you must explore it, it's a very, very powerful, particularly for short-term unstructured markets. What it does is, by crushing time, it simplifies the representation of the price action and shows breakouts very much more clearly than it might do otherwise. So areas of congestion which might be represented on a bar chart like this, a tight trading range, would be represented by nothing there, oddly enough, unless it broke down, and it would have to break down by more than a certain amount before it starts being represented. So this is an extraordinary rearrangement of the price information so that it concentrates on consolidation areas and breakouts, particularly good in FX and in very short-term trading in almost any market.